Welcome back to the Dividend Diplomats YouTube channel. You know you've got your boys Bert and Lanny and Bert. Oh my gosh, the dividend investors here that are rocking out on this YouTube channel. And we're talking again. We're bringing back the railroad companies because you guys asked for it. We're putting a triple threat match together in the ring, looking at three stocks side by side to see if which one is the better stock to buy, and is one a better stock to buy right now.
Before we do that, though, please kindly subscribe to our channel. Give this video a thumbs up. In case you guys didn't notice, we did something different last week. We put out a fourth video last week. We're going to start increasing the number of videos we have here. We're throwing out some shorts. We're trying to grow our following, but also help all of you get to financial freedom with us. That's the goal of it. So yeah, last week we covered Norfolk Southern in a little bit more detail and a lot of the unfortunate news. This week, we're coming back and we're saying, let's see how they stack up against their industry. It's going to be a very great video. Excited to see what pops out here with the train sector.
Eric Bischoff, I'm back better than ever. So, guys, we all know Norfolk Southern, big derailment in East Palestine, plus a bunch of others in, Michigan, Springfield, accident happened in Cleveland, and then another one actually just happened. I think it was Friday or Thursday morning, one of the two here on March 9th or 10th. So Norfolk is making, the news all for the bad reasons. I hope that they didn't bank as well with Silicon Valley. If they did, hopefully they were able to withdraw. No, I'm kidding. But, and with that, it's bringing down the entire transportation services industry. So there's not one transportation company that I'm looking at right now that is up for the year of 2020-23, and actually most of them are down 15 to 25% over the last year.
But look, times like these, when you have one actor that's bringing down the industry, these could present some great buying opportunities for the good actors in the industry, the ones that aren't having the issues, the ones that are operating great, always at a premium that you may never have gotten the chance to buy them at a value you want. So that's what's going to be so cool about this video. That's what's going to be great when we compare Norfolk to these two other competitors. Maybe now you can finally hit that entry point that you've always wanted to at the right yield, the right combo. We'll see if these other two stocks are getting us excited, like we want to just jump in the market next week and scoop them up.
Exactly. So we're going to look at Norfolk Southern, we're going to look at Union Pacific Corp, and we're going to take a peek at CSX to see which of the three railroad companies are the best of the bunch, and to see, hey, is it time to buy one of these stocks, or is it time to wait for the prices to continue to come down? We're going to look at our Dividend Diplomat stock screener, everybody. You know the drill. 1, the price to earnings ratio less than the S&P 500. 2, the dividend payout ratio less than 60%. We love the sweet spot of 40 to 60, giving back majority of it, again, 40 to 60% back to the shareholders and retaining 40 to 60% to grow the business. Then we like to look at a consistently growing dividend with that dividend growth rate and streak. And guys, we'll look at the dividend yield just as the cherry on top. But again, it's always nice to look at the dividend yield in conjunction with that dividend growth rate being key because we want that passive income to go up. Chugga.
So let's start here, everybody. These prices are as of March 10th close. We're recording this on Saturday, the 11th. So keep that in mind as we're going through this analysis. Let's start with Norfolk Southern. Again, let's just start with them, rip the bandit off and see, so we get the baseline to compare the other two companies. Norfolk Southern's price was $210.45. Forward earnings are $13.73. It's a PE ratio of 15.33. So a nice discount compared to the S&P 500, which is in the high teens, low 20s lately.
That's right. And they pay $1.35 per share per quarter, or $5.40 a year, 39% dividend payout ratio. So there's definitely safety in that dividend, as well as plenty of room to continue growing that dividend, which Bert, take Norfolk Southern's dividend growth streak, take a look at it. What's the rate? What's the streak?
All right. Well, they're not quite at Undertaker's streak yet, or Undertaker's former WrestleMania streak yet. Their 5-year dividend growth rate is 8.66%. They've increased the dividend for 6+ consecutive years. So, hey, they're working their way towards it. We'll see how long this dividend stays the same or when they're able to grow it. But ever since the train sector went through that little pause earlier in the mid-2000s, they've increased that dividend annually. So, Lanny, tell us about that yield.
Yeah, let's talk about the yield. Hopefully, Norfolk is saying this to their previous lower yield, just like the taker. Rest So their yield now is swelled. I use the word swell because it's, about 70 plus basis points higher than their 5-year dividend yield on average. It's 2.57%. Guys, as you know, as stock price goes down, as long as the dividend has remained the same, dividend yield has, goes up. So that yield is 2.57%. They're down 15% this year, and they're a 50 billion by market cap company. So not small, but they're the smallest of the three. But the yield is definitely over the S&P 500's dividend yield as well.
So let's summarize them. PE 15, payout ratio 39%, 5-year growth rate 8.6. They've increased that dividend for 6 years with that juicy swollen yield of 2.57%. Lanny, you want to kick this off for Union Pacific?
Yeah, Union Pacific, guys, and again, give this video a thumbs up as well if you're liking this analysis, and if you own Union Pacific. I think I heard a lot of discussion in the comments that people were moving out of Norfolk and going to Union Pacific, for maybe just to get rid of the negative news that they're experiencing from Norfolk, as well as maybe to grab, I think, a higher dividend yield, maybe a higher dividend growth rate potentially.
We'll find out when we start going through this, right?
Is right. So guys, again, they generated 20 plus billion in revenue. Union Pacific, they're trading at $196.06. And their projected earnings from analysts for Union Pacific right now, again, as of March 10th, they're projecting $11.57. So that equals a PE ratio higher than Norfolk's at 15, or Norfolk. Somebody let us know in the comments the correct enunciation for Norfolk. But the PE ratio for Union Pacific is just under 17 at 16.95.
Their annual dividend is $5.20. Payout ratio is 45%. Perfect. Beautiful. Right in our perfect sweet spot.
What's that look like? What's that growth metric look like, B?
5-year dividend growth rate, 15.04%. They've increased that dividend for 16 plus years. It's exactly what you said. People are moving into one that offers higher dividend growth for a longer streak. That's Union Pacific right there, especially compared to Norfolk.
The streak is alive. And again, a little side note, their revenue total has gone up 14% from prior year to 2022. And, again, total assets definitely dwarfs total liabilities, always a good sign for Union Pacific. The dividend yield, is at 2.65%, as Bert was kind of reiterating that things are looking promising for Union Pacific. 2.65% of the yield versus Norfolk's at 2.57, down only 5.5%, but still down this year, while the market has squeaked out a 1% return so far this year. And they're down actually the most, as you'll see, of these three companies, down 25% in the last 52 weeks for this 120 billion by market cap company.
So let's summarize them. PE ratio 16.9, perfect payout ratio of 45% when you round it up. 5-year dividend growth rate's 15%. Increase that dividend for 16 years. The yield is 2.65%. Let's slide over to CSX, ticker symbol CSX, my favorite. Everyone knows I love when that happens. This will be it. So we'll see how number 3 compares to Norfolk Southern and Union Pacific. Their price was $29.49, EPS $1.86. It's a PE ratio of 15.85x for CSX.
15.85, so slightly lower than Union Pacific, slightly higher than Norfolk's. Is that what that looks like?
Yeah, they're right in the middle, right down Main Street there.
Right in the middle, huh?
Yeah, well, let's see the metrics, right? Let's see how the payout ratio looks. What are you seeing here, Lanny?
Well, they pay 11 cents per share per quarter, 44 cents. So a 23.66% dividend payout ratio. So the safest of the bunch. But we'll see if that translates to growth and dividend yield. But yeah, 23.66% Bert on the payout.
Let's look at the growth then. 5-year growth rate's 8.5%. They've increased that dividend for 18 plus years. They're actually the closest to becoming a dividend aristocrat of the group, which I think is actually very interesting.
Yeah, that is very interesting. Looks like revenue, by the way, as another side note, their revenue is up about 19% year over year from 21 to 22. Just like to plug a few of these metrics out there for everybody who's curious about the actual financial performance of some of these companies. Now, the yield, all right, Bert, so you were saying they're almost a dividend aristocrat, over 8.5% dividend growth rate. Their yield has got to be great, right? Well, it's 1.49%. So actually the lowest out of the bunch here. and it actually lower than the S&P 500. So keep that in mind.
Interesting.
Yeah, very interesting, right? That's the comment.
Yeah, lower. I mean, I guess we should have known that was going to be the likely outcome. Their payout ratio is much lower at 23%. That's lower than Norfolk Southern and UMP, who are right around the 40% mark, 45%. So yeah, I guess it makes perfect sense that their yield was 1.49% when both NSC and UMP are yielding over 2.5. That tracks.
Yeah. Guys, they're down about 4.5% this year, down 15% in the last 2 weeks, 60 bill by market cap. In summary here, again, it's less than 16 PE, less than 30% payout ratio, 8.5% growth rate for over 18 years at a yield of about 1.5%. Bert, what is your take right now on these three? Which one do you like? Any reasons?
Well, I can just eliminate CSX right now. I mean, they have the longest streak, but the lowest yield. Just not what I'm looking for in this sector. Obviously, I'm going to pick between NSC and UMP, but I'm still kind of on the fence about the sector as a whole. I looking at these metrics, I get exactly why people are moving out of NSC into UMP. UMP is still a discount compared to the market. They still have a great payout ratio, better dividend growth, better history, better yield. So it makes all the sense in the world to me that they're moving from NSC to UMP. If you want to get into a better run, no, is the wrong way to say it, into a different train from NSC, you go to UMP. I get that. I shouldn't say better run because I don't know if it's better run transparently.
Yeah, I think that's fair. Yeah, and obviously past performance, especially on the dividend side, doesn't necessarily translate to the future, what happens on the dividend increase, plate. But, I don't think I'm buying right now, team, community. Probably going to be watching the industry, seeing what's shaking. I know Bert had a target of 200 for Norfolk. I was in that, 200 to 210. They're about 210 now. They had another derailment, so I'm curious if that's going to put a little bit more pressure, as well as what's going on from the economics, on the macro economy. Not buying, definitely watching Norfolk and UMP. May do an analysis to see like, oh yeah, if I move from Norfolk to UMP, what's my tax impact? Am I able to, is there something there to be had to improve the portfolio, maybe better yield, better growth, less negative news? Yeah. But you can't go wrong buying any of the three.
No, yeah, they're all great. They're just different things. And honestly, with me too, with the other news, everything else that's going on, they're just other sectors I prefer right now too. I'm just going to be, they're both the railroad sector. You should obviously watch NSC and UMP, but there are other sectors now that are also screaming signs of undervaluation. I just prefer to put my cash there at the moment. But again, I get why people like the companies in this sector too.
Or it's running into banking probably right now, as opposed to running.
Yes, that's right. There are a lot of great institutions at a discount. That's story for a different video, everybody. Nice. So if you haven't already, subscribe to our channel, give this a thumbs up. And oh yeah, I forgot to say, everyone, make sure you tell us your thoughts on the trains. I jumped ahead there to the end. Let us know what you think of NSC, UMP, and CSX, and which one you prefer, if any, from the railroad sector.
Keep buying dividend stocks, increase that passive income to financial freedom. You're either with us or you're against us. That's Bert, the Herd, and Lanny from the Dividend Diplomats, over and out.